Welcome to Breaking News to Trading Moves. We are absolutely thrilled to have you joining us today. When you look at the financial news on any given morning, you are bombarded with endless headlines and flashing red numbers.
Right.
But today, we are zeroing in on a very specific, very immediate market reaction. We are looking directly at the recent sell-off pressure on airline stocks. And this sell-off is happening following a sharp spike in oil prices due to the intensifying Iran conflict.
Yes, that is the core catalyst.
Exactly. We're going to explore exactly what that means for U.S.-listed airlines, cruise operators, energy producers, refiners, and defense names.
To set our baseline right from the start, we have to look at the core data driving this movement. Oil has jumped sharply. In fact, it has climbed to its highest level since July 2022. That single factual data point, the highest price since July 2022, that is the engine driving the market rotation we are breaking down today.
Now, before we go any further, I want to make sure you hear this clearly from both of us.
Yeah.
We are looking at this situation purely from the perspective of market mechanics.
Strictly the numbers.
Right. We are impartially reporting on how the market is reacting to the Iran conflict. We are ensuring no political sides are taken whatsoever. Our entire focus is strictly on the data, the equities, and how those numbers are moving in response to the headlines.
Our mission today is very straightforward for you. We are looking directly at the news, and we are evaluating the specific market winners and losers. You will hear no exaggerations from us.
None.
You will not hear commentary on broader global consequences. We are just providing the facts on who is positively exposed to this environment and who is negatively exposed.
Let's start with the absolute reality of the travel disruption because, the data here is quite staggering.
It really paints a clear picture.
It does. Between February 28th and March 8th, there were 37,000 canceled flights to and from the Middle East. 37,000.
That is a massive operational bottleneck.
When you try to wrap your head around that volume, you realize the immense logistical hurdle this creates for the entire aviation network. 37,000 flights in just over a week.
For you to really conceptualize 37,000 cancellations over that roughly 1 week window, you have to think about the physical assets.
Yeah.
This isn't just about a few planes being delayed on a tarmac for a couple of hours. This is about thousands of commercial aircraft suddenly having nowhere to go or being entirely grounded in the region.
Just stuck.
Exactly. The routing maps for global aviation had to be torn up and redrawn continuously.
I keep thinking about the cascading mechanical failure of a number like that. If you are an airline logistics coordinator staring at 37,000 canceled flights between February 28th and March 8th, you aren't just looking at missing ticket revenue.
Not at all.
You're looking at stranded flight crews who are timing out of their legal working hours. You are looking at massive passenger rebooking demands. You have a cargo that simply isn't moving.
And the asset utilization drops to zero for those frames?
Right. A wide-body jet that gets stuck in one location means the next 5 global legs it was supposed to fly are also scrapped.
And every single one of those scrapped flights represents a total loss of anticipated revenue, coupled with the added operational strain of managing the fallout.
It's a logistical nightmare.
You have to pay to park the planes, you have to pay to house the stranded crews, and you have to process the refunds or rebookings.
Yeah.
That specific data point grounds our entire analysis today. It proves that the disruption is happening, it is quantified, and it is putting immense financial pressure on operators right now.
Which brings us to the core financial burden for the airlines, the cost of fuel.
Airlines are the most direct losers from this headline. To fully grasp why, you have to look closely at an airline's operating structure.
Let's break that down for the listener.
For a typical commercial airline, fuel accounts for 20% to 25% of their total operating costs.
Wow.
1/5 to 1/4 of every single cent they spend just to keep the lights on and the planes in the air goes directly into the fuel tanks.
That is a staggering operational expense. If I'm running a logistics business and 25% of my costs are tied to one single commodity and that commodity suddenly spikes to its highest price since July 2022, my profit margin is instantly under siege.
It is an immediate hit to the bottom line.
But here is where the U.S. market specifically runs into trouble. Most U.S. airlines no longer hedge their fuel costs, right?
They don't. And that lack of hedging leaves them entirely exposed to the spot market.
That feels like walking a tightrope without a net.
It essentially is in this environment. Some overseas carriers still utilize financial contracts that lock in a set price for fuel over a future period, which buffers them against rapid price spikes.
Okay.
But the major U.S. carriers generally stepped away from that strategy years ago. They decided to buy fuel at the going market rate. So when the market rate jumps, they absorb the full impact of that price increase immediately.
So they have zero financial armor against this exact scenario.
None.
And on top of that, it isn't just the raw price per gallon of jet fuel that is hurting them. The airspace restrictions we talked about earlier add another layer of pain.
Yes, the rerouting.
When airlines are forced to reroute around conflict zones, planes have to fly much longer paths.
It is an accelerating cycle of cost.
Right.
The shortest distance between 2 points is a straight line, but restricted airspace forces major detours.
Right.
A detour in a commercial jet means burning thousands of extra gallons of fuel.
So you're getting hit twice.
Yeah, exactly. The fuel itself costs more, and you are being forced to consume a higher volume of it just to reach the exact same destination.
Ouch.
The market looks at that compounding operational pressure and immediately starts to heavily discount the future earnings of these airlines.
Let's walk through the direct victims of this fuel spike. When you look at the major U.S. carriers, you've got United Airlines, Delta Airlines, and American Airlines.
Yeah.
So ticker UAL, ticker DAL, and ticker AAL.
Those are the primary operators feeling the squeeze.
They're the ones taking the most immediate hit.
When you analyze the downward pressure on UAL, DAL, and AAL, the core of their struggle is the inability to pass these rapid cost increases to the consumer quickly enough.
Because of how we buy tickets.
Precisely. The commercial aviation business relies heavily on advanced bookings. Millions of tickets have already been sold for flights weeks or months from now. And those tickets were priced based on the fuel costs from last month.
So if I bought a ticket 6 weeks ago for a summer vacation, the airline collected my money based on their internal models of what fuel would cost at that time.
Correct.
Now, the flight is approaching. Fuel is drastically more expensive, the highest since July 2022. But they can't exactly send me a bill for another $50 to cover the difference.
They absolutely cannot. The airlines are forced to absorb that entire cost difference.
Wow.
They simply cannot adjust their pricing algorithms dynamically enough to offset an overnight spike in crude oil for the tickets that are already sold.
The revenue is locked, but the costs are floating upward.
This lag in pricing power makes their margins highly vulnerable. When oil jumps this fast to those July 2022 highs, the profitability of UAL, DAL, and AAL is immediately compressed.
But the travel pain isn't contained just to the skies. Let's move over to the ocean. We need to look at the U.S. cruise operators.
A very similar dynamic there.
Norwegian Cruise Line, Carnival, and Royal Caribbean. That gives us ticker NCLH, ticker CCL, and ticker RCL. Why are they getting swept up in this?
The cruise operators find themselves in a uniquely difficult position. They are doubly exposed to this exact macro environment.
Doubly exposed.
Yes. First, they share the exact same fuel cost problem as the airlines. Those massive vessels consume colossal amounts of fuel, and the cost to power those ships is soaring alongside jet fuel.
Right, bunker fuel isn't getting any cheaper.
Exactly. They have that same heavy cost burden sitting right on their balance sheets.
But you mentioned they are doubly exposed. If the fuel cost is one side of the equation, what is the second half?
The second half is the fragility of consumer travel demand. A cruise is the pure definition of discretionary spending.
It's a luxury.
It is. If oil stays high and travelers become increasingly cautious because of global instability and geopolitical tension, they delay their travel plans.
That makes total sense.
It is generally easier to cancel or postpone a luxury cruise than a mandatory business trip or a family emergency flight.
If you are watching the evening news and seeing intense conflict, you might just decide to hold on to your cash and stay home.
Human nature plays a major role in these booking metrics.
So NCLH, CCL, and RCL are getting squeezed by a classic pincer movement. Their operational costs to run the physical ships are skyrocketing, while simultaneously the risk of consumers delaying travel hurts their forward bookings.
Exactly. Higher expenses and the looming threat of lower revenue. The market reacts to that double exposure by stepping away from those stocks.
This brings us to a secondary impact that might not be obvious at first glance.
The downstream players.
Yeah. If fewer people are flying and fewer people are cruising, what happens to the companies that facilitate those bookings?
They feel the chill very quickly.
That leads us directly to the U.S. online travel and booking platforms. We are looking at Booking Holdings, Expedia, and Airbnb. So ticker BKNG, ticker EXPE. and ticker ABNB.
This is where you see the broader travel ecosystem reacting.
Break that down for us.
If geopolitical tension reduces discretionary travel, these platforms suffer. Additionally, as airlines eventually do pass those higher fuel costs onto the consumer in the form of more expensive tickets over the coming months, travel simply becomes less affordable.
Wait, let me stop you there. These are essentially software companies.
They are.
They don't have to buy jet fuel or bunker fuel for cruise ships. Their operating margins aren't tied to the price of a barrel of crude oil. So why does the market punish them?
Because they rely entirely on transaction volume. If a family sees that airline tickets have jumped in price due to the fuel pass-through, they might scrap the vacation entirely.
Yeah.
And if they scrap the vacation, they aren't using these platforms to book their hotels, their rental cars, or their flights. The platforms take a cut of the total volume.
So even though their direct costs are stable, their revenue pipeline is completely dependent on consumer willingness to travel.
Exactly. No bookings, no fees.
Investors look at the travel disruption, look at the higher oil costs making future travel more expensive, and start factoring in softer booking volumes. The sentiment sours, and BKNG, EXPE, and ABNB face downward pressure.
It is a straightforward volume equation for the market.
So far, we have covered the downward pressure. But in the market, money is always moving somewhere. If capital is fleeing the airlines and the travel platforms, where is it going?
It rotates to the beneficiaries.
Let's look at the other side of the trade. We're going to examine the most direct beneficiaries of surging crude prices, U.S. oil producers.
The upstream side.
ExxonMobil, Chevron, and Occidental Petroleum. Ticker XOM, ticker CVX, and ticker OXY.
For these producers, the equation is incredibly direct.
Because they pull it out of the ground.
Exactly. They extract the exact resource that is suddenly in higher demand and constrained supply. If oil remains elevated at these levels, again, the highest since July 2022, investors immediately expect stronger upstream earnings.
The market is paying them more for every single barrel they produce.
Yes.
Their cost to extract it hasn't changed, but the selling price has spiked.
And that surge in revenue translates directly into better cash flow.
Cash is king.
In the current market environment, companies with massive, sudden inflows of free cash flow are highly prized. That cash provides a very supportive environment for shareholder returns.
Like what specifically?
Specifically, it allows these companies to execute aggressive stock buybacks and maintain or grow their dividends.
So if you are an investor watching supply fears drive oil prices sharply higher, your first instinct is to rotate your capital into the companies that are actively producing the commodity.
That is the textbook move.
XOM, CVX, and OXY become the immediate destination for that capital rotation.
They are the primary beneficiaries of the supply anxiety. But the value chain doesn't stop at the wellhead. We also have to examine the U.S. refiners.
Okay. Valero Energy, Marathon Petroleum, and Phillips 66. Ticker VLO, ticker MPC, and ticker PSX.
The refiners play a crucial role here.
Now, I need you to pause right there because this is where the logic seems a bit counterintuitive to me.
How so?
The producers get the oil out of the ground, and the refiners buy that crude to turn it into the actual products we use, like jet fuel and diesel.
Right.
If crude is their main ingredient, and crude is at its highest price since July 2022, shouldn't their costs be through the roof too?
Okay.
How does a massive expense turn into a tailwind for them?
It is a great question. Their input costs absolutely go up.
Okay.
But refining profitability is entirely about the margin between the raw input and the finished product.
The spread.
Exactly. When the market experiences a geopolitical shock like this, refined fuel prices often rise even faster than the raw crude. If jet fuel and diesel become scarcer due to the disruptions we discussed earlier, the product market tightens.
Let me make sure I have the mechanics of this right. The airlines are desperate for jet fuel to keep their planes in the air, especially with the longer rerouting paths we talked about.
Yes.
That demand for the finished product stays rigid or even increases regardless of what crude is doing.
Exactly. And because the product markets are tightening while demand remains rigid, the refining margins, the spread between the cost of the crude and the selling price of the refined jet fuel, can actually improve.
Wow.
The refiners command a premium for delivering the scarce end product. This gives VLO, MPC, and PSX a very strong potential tailwind, even in a high crude environment.
So the airline's biggest pain point essentially becomes the refiner's biggest profit driver.
That is the reality of the supply chain.
Now let's move out of the energy sector completely. Our final group of winners is driven by the geopolitical reality of the headline itself, U.S. defense contractors.
A completely different angle, but highly relevant.
Lockheed Martin, Northrop Grumman, and RTX. It's ticker LMT, ticker NOC, and ticker RTX.
This is a fascinating mechanism to observe.
It's not about immediate sales, is it?
No, this movement is not about a direct overnight change to these companies' current earnings. It is entirely driven by sector rotation and investor sentiment based on the escalating military conflict.
The market is essentially looking at the horizon. They see the intensifying Iran conflict, they see the 37,000 canceled flights, and they assume that governments globally are going to have to respond by increasing their defense budgets.
That is the core thesis.
They are preempting the contracts.
Investors anticipate a future environment of higher demand for missile systems, advanced aircraft support, surveillance networks, and broader defense capabilities. They are pricing in a prolonged period of geopolitical instability.
So capital flows into LMT, NOC, and RTX because investors want to be positioned ahead of those anticipated government contracts.
Exactly.
Even if the ink isn't dry on a new defense contract today, the sentiment dictates that these companies are the safest place to park capital during military escalation.
To bring all of this together and summarize the mechanics we have analyzed today, the spike in crude prices driven by this conflict creates a remarkably clear dividing line across the market.
A line in the sand.
On one side of that line, you have the entities dependent on cheap fuel and strong consumer demand to sustain their margins: the airlines, the cruise operators, and the travel booking platforms. They are bearing the brunt of the immediate operational pressure.
Losers in this scenario.
Yes. On the entirely opposite side of the line, you have the companies that extract that fuel, the companies that refine it into scarce products, and the defense contractors positioned to supply capabilities during geopolitical tension.
The winners.
The capital is aggressively rotating from the former directly into the latter.
It is a stark contrast, and it highlights exactly how a single headline mechanically moves through different sectors of the economy. So what does this all mean for you as you watch the market going forward?
It requires close observation.
I want to leave you with a final thought to mull over on your own. Considering that heavy 20% to 25% operating cost burden we discussed, if U.S. airlines rigidly continue their strategy of not hedging fuel, how vulnerable does that leave their long-term profitability if this kind of geopolitical instability becomes the permanent normal? This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.